Welcome to Bloomberg Markets. I'm Scarlett Fu. We're seeing stocks get hit after cautious outlooks from some of Wall Street's biggest banks. And here's how it's showing up across the different asset classes. Of course, you start with stocks. They did start the day mixed, but have since turned lower. I mentioned financials. We also have energy helping lead the declines. The NASDAQ giving up early gains, now down by 0.3%, but is actually the outperformer here in that it is falling less than the other main indexes. Treasuries are firmer, so that is pushing yields down. The 10-year yield at 3.65%. That is a 15-month low. And take a look at oil. This is Brent crude off by almost 4%, falling below $70 a barrel on oversupply fears. And this is after OPEC trimmed its forecast for demand growth for a second time in 2 months. Now, the headline numbers for stocks are indicating a lot of red, but we want to zero in on a couple of those individual movers, starting with the financials. Abigail?
Yeah, JP Morgan is the worst performer for the S&P 500 right now on the day, down about 7%. This is the worst day going back to 2020. You can really see this plunge here in this two-day chart, and essentially dropping on President Daniel Pinto, saying that analysts and investors are a little bit too optimistic about next year's net interest income. The estimate currently, I believe, $89.5 billion. He's saying that is too high. Now, this is interesting only because we have so many mixed tells from consumers on the retail space. The fact that one of the biggest, if not the biggest money center bank of the world is saying that analysts are a little bit too optimistic about next year, and the consumer GDP is about 2/3 of GDP. There's something to think about there. Maybe there's a little bit of economic softness ahead. It's also having to do with the idea that yields here have been moving lower. Citigroup, Goldman Sachs trading down in sympathy. Take a look at Ally Financial, though, in a class of its own, down 18.4%. I think this is the worst day for that stock since 2020 as well. But this has to do with the presentation at Barclays that the company made, saying that they're seeing lots of auto loan delinquencies, that credit conditions are tough. Credit card delinquencies are at a multi-year high, and you can see this is weighing on Capital One Financial. But to be clear, Ally Financial, that's financial loans on cars, vehicle loans, but that the overall credit complex is difficult. So the bank sector clearly in a world of pain. Let's turn to one bright spot, though, Scarlett. There's more than one, but here is one. Oracle up about 12%, a very good quarter, record profits, record sales. Their sales grew 7% on a year-over-year basis. AI demand helping out, and Microsoft seems to be going along for the ride. Many of the other big tech names, such as Apple and Alphabet, actually I don't know about Alphabet, but Apple at least, not doing so well. But Microsoft going along again with that AI demand, and Oracle having one of its best days in quite some time.
Yeah, investors really liking the news about Oracle and its partnerships with some of those hyperscalers. Abigail, thank you so much. Abigail Doolittle with our movers at midday. Now, overall, markets are still eyeing inflation as a potential dampening factor, with some of them saying higher prices have structural staying power. Take a listen to what our guest said earlier today.
We do see inflation eventually settling at a level that is higher than pre-pandemic levels because of structural constraints coming from the low carbon transition, coming from geopolitical fragmentation, coming from ultimate labor shortage from aging population. So markets are currently reacting as though we're going to have a lower and friendly inflation prints, which feel about right, but it's underappreciating the level to which we're all going to have to live with structurally higher inflation.
For more on what markets are pricing in ahead of tomorrow's CPI print, let's bring in BMO Capital Markets senior economist Jennifer Lee. Jennifer, it is always good to speak with you. Clearly, investors have gotten very comfortable with this narrative that inflation has moderated and is approaching the Fed's 2% target. It's no longer the risk that it once was for investors. Do you see any reason for tomorrow's CPI print to stray or challenge that narrative?
Well, first of all, good afternoon. Thanks for having me on. You know, there is a chance, like we are actually just, along with consensus, we're looking for inflation to continually moderating for the 5th month in a row. Now, there is a chance that we could see some stickiness, you know, for example, on the rent side or even with, you know, airlines perhaps. But I think it would take a lot more than just 1 month of sticky inflation to change the narrative of what the Fed is planning to do. We continue to look for that 25 basis point rate cut next week, and what will be more interesting, I think, is just to hear how dovish the Fed chair is going to be during the press conference. But certainly longer term, I think your previous guests, I completely agree. There is still some upward pressure, I think, keeping prices elevated. Even though the pace of inflation growth has slowed, price levels are still very high, and there's a number of factors that will continue to keep them elevated. But what we want to see, which is what we have been seeing, is cooling inflation growth overall, 4 months in a row. And I think, it's going to take more than just 1 month to change that narrative around.
Yeah, I mean, the key question here for inflation, as it has been for the past couple of months, is whether this slowdown in CPI is sustainable. What do you look at to help answer that question?
So we look at lots of factors, of course, but I think it's going to go back down to the consumer, just given that, the huge role that the consumer plays in driving the U.S. economy. And as long as, we've already seen slower job demand or labor demand, still growing, but still obviously at a slower rate. And that is going to help control, and of course, wages, and that's going to help decide what in the consumer's mind, whether or not they're going to keep spending or put a little bit away for a rainy day, which is never a bad thing. I think that's the biggest thing to look at. Of course, various commodities as well, and having oil coming off by a few dollars so far today would actually help the inflation story, longer term, if there is some staying power. But I think overall, what we look for in terms of broader U.S. growth, it just always go back to the U.S. consumer, job demand, and of course, wage growth to see how, that's going to drive consumer spending going forward.
Yeah, it makes a lot of sense. So I wonder how you fold in the anecdotal, in particular, what the big banks are saying today and yesterday, of course, with JP Chase seeing its shares decline today because the president, Daniel Pinto, says that analysts are being far too optimistic in projecting next year's expenses and net interest income. I know that this might be specific to the banking sector, but what does it tell you overall about the health of the corporate sector and how that feeds into the strength of the economy?
So the corporate sector there's obviously been slower in business investment, I think, and this is partly because of slower demand worldwide. You're seeing a lot more protectionist plays being playing out around the world. But at the same time, there's also some holding it back, some hesitation in more business investment and borrowing ahead of the coming elections in November. And until we see that, come and go, then I think we're going to start seeing or continue to see weakness, I think, in the corporate side, just in terms of the investment side, just given uncertainty overall and of course, just slower demand in general. So I think there is definitely some truth to that.
Yeah, absolutely. The Fed obviously has a dual mandate. It has to manage inflation and also maximize employment. Inflation was certainly priority number one for the hiking cycle, but you can argue that employment will be the bigger priority when the cutting cycle actually begins. So I'm curious to hear from you, how much does tomorrow's CPI print and maybe the following day's PPI print answer the question of whether the Fed will go with 25 basis points or 50 basis points in its decision to cut?
So I'm probably going to jinx it right now, but I'm sort of wondering to myself, how important is this inflationary report? I mean, obviously, it's part of the Fed's dual mandate, as you pointed out, but I think it holds a little bit less water these days, just given that, again, we've seen 4 consecutive months of better inflation data, which is giving the Fed the confidence and the comfort to start cutting rates, which everyone believes is going to happen next week. So all the focus is on the labor market. Now, whether or not it's going to determine a 25 or 50 beeper, I don't think it's going to do that either. As I said earlier, it's going to take more than 1 month of a change in inflation, like an upturn, for example, to change the narrative. It's going to have to make the Fed a lot more, uncomfortable and less confident for them to change. But I think, just given, again, what we've seen so far in terms of slower employment growth, slower economic activity. We're still seeing some consumer spending, as we saw from the July report. So we're gently tapping on the brakes, as I always say. We're not slamming on the brakes just yet, but I think everything should be pointing to a 25 basis point rate cut. But again, I don't think one CPI report is going to change that narrative.
All right, fantastic. And just a quick question for you before we say goodbye to you. The first presidential debate, of course, takes place tonight. Debatable whether we'll actually learn anything new when it comes to policy proposals. But I'm curious, as an economist, what you will be listening for that could help you figure out some of your forecasts.
very curious to see how hawkish they're going to be on the tariff front, on the protectionist front, because no matter what party takes over the Oval Office or Congress, we're going to see protectionism continue to, or tariffs to continue to be amped up, I think. So how aggressive each party will be, I'll be listening for very carefully. I'm also curious as to see what their stance is on the U.S. dollar. At one point, we're hearing calls for a weaker dollar, and then just recently, we're hearing calls for a stronger dollar. So I'm curious to how they're going to be playing or talking about that topic, and of course, taxation. Lower taxes for is it for every single industry, every single state, or are we just going to be specific on who we're targeting or which industries we're targeting? So taxation, tariffs, that's what I'm thinking about.
All right, Jennifer Lee, really appreciate your time. Jennifer Lee is BMO Capital Markets senior economist. Now, one reason when I look at markets right now and the price action is fairly muted is, of course, election risk. And tonight, as we mentioned, marks the first time Americans will see Vice President Harris and former President Trump side by side in a debate. Let's go now to Bloomberg's David Gura, who is on the ground at the debate venue in Philadelphia. David, this is not the first. It's not just the first debate between Harris and Trump. It's also the fact that the two have actually never met and spoken to each other before. Is that right?
That's correct. So there's a lot of drama just inherent in that. How are these two candidates going to interact with one another, talk to one another? What's that moment going to be like right from the get-go? I think that's going to be a huge focus here, and we'll see where we go from there. I'm sympathetic to what Jennifer Lee was telling you just a moment ago, that wish that we're going to get a lot of policy specifics, talk about taxes, tariffs, all manner of economic issues we've heard these candidates talking about in recent weeks. Color me a bit skeptical that we're going to get a lot of detail there, but certainly I think the economy is going to be something that's talked about in kind of a broader macro way during the course of this debate, which is supposed to last about 90 minutes. And it's going to be very similar in format to what we saw in Atlanta back in June. Of course, the composition of the debate stage has changed. Since then, you have former President Trump against Vice President Harris, not President Biden. But again, mics will be muted when one candidate is speaking, so there will not be the opportunity for kind of spontaneous exchanges we've seen in past debates, but we'll certainly be looking, to your point, for any signs of drama or sort of what it looks like, the kind of theatricality or the drama of the moment on stage here in Philadelphia. Okay, so the rules from the Atlanta debate kind of carry over into this particular one. You mentioned that we're not going to get a lot of specifics, and yes, I think it's safe to say that they're going to be looking to connect more with potential voters than anything else. Who's got the momentum here right now? When you talk to people in Philadelphia, what's the word? Yeah, that's a great question. So this is such a compressed campaign. Vice President Harris has only been running for a matter of weeks, and as a result of that, we haven't seen the kind of ebbs and flow of support momentum that we would see during a regular campaign or a normal campaign, the likes we've seen before. So right out of the gate, her numbers improved compared to President Biden. There wasn't a kind of bump or boost after the Democratic National Convention. We have seen signs that there could be some stalling in support for her campaign in the most recent polls, most notably in the New York Times Siena College poll, where they're neck and neck. That was not unexpected within the margin of error. But again, it seems to be that there is a stalling or a narrowing in support for Vice President Harris. That's something that certainly she and her campaign are paying attention to, and they, perhaps more than the Trump campaign, are cognizant of this opportunity to introduce herself or reintroduce herself to the American people. You look at that poll, that Times Siena College poll, and there are still so many Americans in this country, more than a quarter of the respondents to that survey, who say they don't really know who she is or what she stands for, or what her policies would be. If this is in fact the only presidential debate that we have between now and Election Day, it's just a crucially important moment, Scarlett, for her to be able to talk to those voters and kind of allay some of their, if not fears, anxieties about who she is and what she stands for. Okay, and for now, this is the only one that is scheduled between now and Election Day. What about a potential vice presidential debate between J.D. Vance and Tim Walz? So that's scheduled to take place on October 1st in New York City. That'll be interesting to watch as well. I mean, we have both of these candidates who haven't appeared on the debate stage at this level before. Of course, neither has run for higher office, and they're new running mates. So that'll be interesting just to see sort of how they play off of one another as well. And I'll say, we continue to watch them day in and day out, doing quite hard work and a lot of travel across this country. And the expectation is after this debate concludes tonight, they, both J.D. Vance and Tim Walz, will be traveling across the country to many of these swing states to talk their book, play up their particular candidates. So we'll be seeing a lot more of them in the run-up to that debate again, which is scheduled to take place at the beginning of next month on October 1st. All right, David Gura, thank you so much. David Gura joining us from Philadelphia. And of course, be sure to tune in to our debate coverage and simulcast tonight. That begins at 8 p.m. New York time.
Now coming up, JP Morgan shares dropping the most since 2020 after one key company executive downplays Wall Street expectations for their earnings. It's our stock of the hour next. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour, and we're watching JP Morgan diving today as the firm tempers expectations for its revenue outlook. You look at the shares, they're down the most in more than 4 years and leading bank stocks lower after President Daniel Pinto made comments at an industry conference. For more on this, let's bring in Bloomberg senior reporter Sridhar Natarajan. So, Sri, what exactly did Daniel Pinto, who's the president of JP Morgan Chase, say about current estimates for results?
Pinto was there at the Barclays conference, and he made the point about how the analyst expectations, especially for net interest income, is a bit too high. He pointed about the NII estimates, the expense estimates, and it does appear that the stock has taken a dive following those comments. It's down about 7%, the most since June 2020. But at the same time, I'd probably say JP Morgan executives must be a little bemused. For a while, they've been talking about how they've been over-earning from NII. We know the Fed is going to start cutting rates, so it is likely to come down. But analysts will tell you, every time JP Morgan has been putting out a target there for the last couple of years, they've been meeting it and beating it. So maybe their expectation optimism wasn't misplaced. Pinto has come out there and said it probably is misplaced. It needs to be revised lower.
Okay, so there was this game of setting the bar low and beating it. What are the vibes at this conference? Because Goldman Sachs made some remarks yesterday that didn't exactly set the tone very kindly for today.
No, that's absolutely fair. The mood music out of this conference is certainly downbeat. Goldman Sachs and Morgan Stanley both talked about, let's talk about the investment banking side of the business. It's good in terms of conversations, but not necessarily in terms of revenue realization. Morgan Stanley said that M&A and IPO revenue through the end of the year at least will remain below historical trend lines. I think the market is impatient for that revival to land and actually turn into real revenue. We also talked about trading not being as great as last year. And on the consumer side, you've heard commentary from both Citi and Ally Financial that gives us some reason for pause. And that's being reflected in the bank stocks today.
Absolutely. Investors impatient? How could that be? Sri Natarajan, thank you as always. Now coming up, we're going to take a look at the auto sector because BMW has cut guidance and auto dealerships across the U.S. are now offering lower leases because of slowing EV demand. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. Let's turn now to the auto sector because BMW warning a recall affecting some 1.5 million vehicles due to faulty braking systems will cut its profit this year. The German automaker now sees earnings significantly lower than the 17.1 billion euros that it printed a year ago and is now forecasting its automaking operation margin could be as low as 6%. Shares of BMW plunging 11% in European trading. Here in the U.S., car dealers are lowering prices to move EVs off their lots before year-end, mainly through leases. Now, by one measure, leases accounted for a record 32% of EV transactions in the U.S. in the first quarter, well above the industry-wide share of 19%. Jessica Caldwell, head of Insights at Edmunds, joins us now to discuss this trend further. So, Jessica, leases were super popular in the zero interest rate environment a couple of years ago, but they lost some of their appeal in the higher for longer rate environment that we're currently in. Why are leases for EVs so popular then?
Well, there's two things happening with EVs. One, you can get the federal tax, the IRA credit rolled into your EV, so that makes automatically that payment lower. But also just the incentives are there. I mean, these vehicles aren't moving. So leases is one way that you can probably get consumers to feel more comfortable with the technology because they know they don't have to own it forever. And as a result, EV leases are really the best deal right now in the new vehicle market.
Yeah, apparently EV leases on average cost $88 less a month than a new EV loan. You mentioned how it's a combination of weak demand and too much supply, but I wonder which one is the bigger driver? Is it going to be weak demand or too much supply for what we're seeing right now?
Well, I think right now it's weak demand. However, the supply issue is going to work itself out. So if you are looking for that EV lease, you probably have a window of 6 months to a year, and then production is going to catch up with demand. As we know, a lot of automakers have been cutting back production, so we're not going to have an overstock of EVs forever. So the window is short. So it really is that low demand right now that is pushing things through, because we know production and inventory will change over time.
Yeah, that's helpful to know. That $7,500 tax credit you referred to, is that a permanent tax credit or does that expire as well?
That is the federal IRA tax credit. So it is a bit tricky because if you purchase an EV, so if you're not leasing it, a lot of times it won't apply. There's a limited number of vehicles. There's a lot of income requirements on the buyer. But if you lease it, it's a bit of a loophole because it's not technically a retail customer. So you can apply that whole $7,500 to most EVs. And when you think about a 3-year payment, that really helps and cuts into the EVs. And we see EVs with MSRPs that are in the 40s, pretty much with the same lease payment of internal combustion engine vehicles that are in the $20,000 range. So it's apples to oranges really in the payments.
Doesn't this just mean, Jessica, that in 2 to 3 years, dealers are going to have a flood of used EVs coming back to their lots that they'll have to then get rid of?
Yeah, that is the issue. So, automakers are taking the risk on this. The one thing is that we know that there is interest on the lower priced EV side. EVs, because the residual value hasn't been great, they've been a great deal so far. And we have seen a lot more demand on the used vehicle side because they feel like, oh, I can get this new car with new technology for almost the same price as something that, doesn't have the new technology. So they will do better on the used side because there is demand of people that want something that is cheaper, but it's going to be hard to, kind of mitigate that, all of the vehicles that are coming off lease and what the prices are. But I think automakers know that they'll be, taking a bit of a cut, a profitability cut on them.
Yeah, exactly. I think they're just kind of going to figure that problem out later on. But certainly it'll be interesting to see how many of those leases roll into actual purchases as well down the road. Jessica, thank you as always. Jessica Caldwell is Head of Insights at Edmunds. And I'm Scarlett Fu. That does it for Bloomberg Markets this hour. We're keeping an eye on what's going on in the equity markets. The S&P 500 has come off its low and is now just down 0.2%. The Dow Industrial is losing about 0.2%. We're also seeing yields come down quite a bit. The 10-year yield at 3.65%. This is Bloomberg.